Before we dive in, please remember that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided in this presentation is not a substitute for professional advice tailored to your individual situation. Always consult with a qualified and licensed professional for your specific insurance needs. That feeling hits you in the gut. You open the mail or you get that email notification, and there it is, your auto insurance bill. And it's gone up. Again, you haven't had an accident. You haven't gotten a ticket. Your car is a year older, so it's worth less. Yet somehow you're paying more. If that sounds familiar, I want you to listen very, very closely, because you are almost certainly being overcharged. Not by a little, by a lot. We're talking hundreds, maybe even over $1,000 a year, that is leaking directly out of your bank account and into the pockets of a multi-billion-dollar industry that is banking on one thing: your silence. They are profiting from your confusion and your belief that this is just the way it is. Well, I'm here to tell you it's not. The entire system is designed to be confusing. It's a maze of jargon, hidden discounts, and pricing algorithms that feel more like a casino than a service. But today we're handing you the map. We are going to expose the 10 smartest, most effective strategies to slash your auto insurance bill in the United States. These aren't just vague tips like drive safely. These are the specific, actionable secrets the insurance industry doesn't want you to know. Because if everyone knew them, their profits would plummet. By the end of this video, you will have a clear step-by-step playbook to stop the bleeding and put that money back where it belongs, in your pocket. Let me tell you about Mark. Mark is a 42-year-old project manager from Texas. He's a good driver, a perfect record for over a decade. He drives a 2018 Toyota Camry, a reliable, safe car. He'd been with the same big-name insurance company since he was 25 years old. For 17 years, he was a loyal customer. He paid his bill on time every time. He even had his home insurance bundled with them. He thought his loyalty meant something. He thought he was getting a deal. His 6-month premium was $980, about $163 a month. He just accepted it. He figured that's what insurance costs for a guy his age in his area. Then one day, a coworker mentioned he was paying less than $100 a month for 2 newer cars. Mark was floored. It didn't make sense. So, that night, fueled by a little bit of frustration and a lot of curiosity, he spent 30 minutes online. He didn't even switch companies. He just went through his own policy line by line, armed with a little bit of knowledge I'm about to give you right now. He made a few phone calls. The result? His next 6-month premium with the exact same company, for the exact same coverage, dropped from $980 to $610. He saved $370 in half an hour. That's a $740 per year savings. He was furious. He felt betrayed. For years, he had been paying a secret penalty, a tax for being a good, loyal customer. Mark's story isn't unique. It's the story of millions of Americans. And the first, and arguably the most important, way to find cheap auto insurance is to understand and defeat the single most profitable weapon they have against you. This brings us to smart way number 1. Stop paying the loyalty tax. Write this down. The loyalty tax. It sounds crazy, doesn't it? In every other area of life, loyalty is rewarded. You get a free coffee after 10 purchases, you get member-only discounts at the grocery store, you get upgraded on a flight. But in the world of auto insurance, loyalty is often punished. It's a penalty for not shopping around. Here's how it works. Insurance companies spend a fortune on advertising to get you in the door. They'll offer a super competitive, low introductory rate to win your business. You sign up, you're happy, you put your payments on autodraft, and you forget about it. Then 6 months later at renewal, the price creeps up by 3%. You might not even notice. A year later, it's up another 5%. Then 4%. Each individual increase is small enough that it doesn't trigger alarm bells. It's not enough to make you go through the hassle of shopping for a new policy. They are boiling the frog slowly. They know you're busy. They know you have kids, a job, a life. They know you'd rather do literally anything else than compare insurance quotes. And so, year after year you stick with them, and year after year that loyalty tax compounds. Meanwhile, that same company is offering brand new customers, with your exact driving profile, a much lower rate than the one you, their valued customer of 17 years, are paying. Their best prices are reserved for the people who are not their customers yet. It makes no sense, but it makes them billions. So what is the antidote to the loyalty tax? It's simple, but it requires a shift in your mindset. You must treat your auto insurance policy like you treat your cell phone plan or your cable bill. You have to be willing to walk. Your new mantra is, always be shopping. I don't care if you love your agent. I don't care if their app is easy to use. I don't care if you've been with them since you got your driver's license. Your loyalty should be to your budget, not to a faceless corporation. Here is your action plan for this first crucial step. I want you to do this today. First, find your current auto insurance policy. It's usually called the declarations page. Find the total premium for your 6-month or 1-year term. Circle it. Stare at that number. That is your baseline. That is the number we are going to beat. Second, set a calendar reminder on your phone. Set 2 of them. One for 6 months from now and one for 1 year from now. Title it, Shop for Car Insurance. Make it a recurring event. This is non-negotiable. This simple act of scheduling it turns a vague intention into a concrete commitment. Third, you need to actually compare prices. In the past, this was a massive pain. You had to call 5 different agents, give them all your information over and over, and wait for them to call you back. It was awful. Today, it takes less than 20 minutes. There are numerous online comparison tools, you've seen the commercials for them, where you enter your information once, and they pull quotes from a dozen or more different carriers in minutes. Use them. They are your new best friend. You should also call a local independent insurance agent. They work with multiple companies and can often find deals and discounts that the online tools might miss. Your goal is to get at least 3 to 5 competing quotes. When you do this, you might find that your current company is still the cheapest. It happens sometimes. But now you know for sure. You're paying that rate from a position of power and knowledge, not from a position of apathy. More likely, however, you will find what Mark found. That other A-rated, reputable companies are willing to offer you the exact same coverage for significantly less money. And here's the pro-level move. Let's say you find a quote that's $200 cheaper for the same coverage. Before you switch, call your current insurance company's customer service line. Tell them very politely but firmly, "Hello, I've been a loyal customer for X years. I'm calling because I've received a competing quote from another company for identical coverage that is $200 less than my upcoming renewal. I would prefer to stay with you, but the price difference is just too significant. Is there anything you can do to match this price?" Sometimes they'll say no. But you would be absolutely shocked how often a special discount is magically found in their system. The simple act of showing them you've done your homework and are prepared to leave can suddenly unlock a better rate. They might not match it completely, but they may come down enough to make it worth staying. Either way, you win. You either get a lower price from them, or you switch to the new company and get an even lower price. This one strategy, this single commitment to shopping your policy every renewal cycle, is the foundation of everything else we're going to talk about. It is the single biggest lever you can pull to lower your costs. Think about it. If you spend 30 minutes every 6 months and save $300, you just earn $600 an hour for your time. Find me another side hustle that pays that well. You are not just a customer. You are a free agent in a competitive market. It's time you started acting like one. Because the loyalty tax is real, it's costing you a fortune, and it stops the second you decide to fight back. Now, shattering the loyalty myth is a huge first step. But what if I told you there's another factor, completely unrelated to your driving, that could be secretly inflating your premium by 30, 40, or even 50%? It's a 3-digit number that insurers are obsessed with, and fixing it is the key to unlocking the absolute lowest rates possible. That's exactly what we're breaking down next. This secret 3-digit number has nothing to do with your driving record, the car you own, or how many speeding tickets you've had. It's your credit score. And I know what you're thinking, what on earth does my Visa bill have to do with how I drive my Honda? It's a fair question, and the answer is one of the biggest, most controversial, and least understood secrets in the entire insurance industry. You see, decades ago, insurance actuaries, the math wizards who calculate risk for a living, stumbled upon a bizarre correlation. They crunched mountains of data and found that, statistically speaking, people with lower credit scores tended to file more insurance claims. Not just more expensive claims, but more claims in general. The correlation was so strong, so consistent across millions of drivers, that they couldn't ignore it. So they created something called a credit-based insurance score. This is crucial to understand. They're not looking at your credit score to see if you can afford your premium. They already know you can, or they wouldn't sell you the policy. They are using your financial history as a crystal ball to predict your future driving behavior. In their eyes, a person who manages their debt responsibly, pays their bills on time, and doesn't max out their credit cards is also more likely to be a responsible, cautious, and low-risk driver. Someone who is financially overextended, they theorize, might be more stressed, more distracted, and more likely to make a risky decision behind the wheel, or perhaps more likely to file a small claim that a person with more financial cushion would just pay out of pocket. Now, is this fair? Absolutely not. It's a statistical shortcut that punishes people for things like past medical debt, a messy divorce, or a period of unemployment, life events that have zero to do with their ability to safely merge onto a highway. But is it legal? In most of the United States, you bet it is. Only 3 states, California, Hawaii, and Massachusetts, have banned the use of credit scores in setting auto insurance rates. For the other 47 states, it's fair game, and it has a massive impact on your wallet. Let me paint you a picture. Meet 2 drivers, Sarah and Jessica. They're both 35 years old. They both live in the same suburban neighborhood in Texas. They both drive a 2021 Toyota RAV4. And here's the kicker. They both have a completely spotless driving record. No accidents, no tickets, not even a parking violation for the last 10 years. On paper, they are the exact same risk. They should pay the exact same premium, right? Wrong. Because there's one difference. Sarah went through a tough time a few years ago. She had to use her credit cards to cover some unexpected expenses, and her credit utilization shot up. A couple of payments were 30 days late. As a result, her credit score is sitting at 590, which is considered fair or poor. Jessica, on the other hand, has always been diligent with her finances. She keeps her credit card balances low and has never missed a payment. Her credit score is a pristine 790, which is excellent. When they both go online to get an insurance quote for the exact same coverage, from the exact same company, Sarah's quoted a staggering $175 a month. Jessica gets a quote for just $90 a month. That's a difference of $85 every single month. Over the course of a year, Jessica is paying over $1,000 less than Sarah, for no other reason than her credit history. Sarah is being penalized as if she's a high-risk driver, even though her driving record is perfect. This is happening to millions of Americans right now, and most have no idea. They just assume the high rate is because of their age, their car, or their zip code. But often, the silent killer is a credit score that's holding them back. The good news is, unlike your age or where you live, your credit score is something you have direct control over. Improving it is one of the most powerful things you can do to slash your insurance costs, and it doesn't have to be complicated. Here is your 5-step battle plan to turn your credit score into an insurance discount generating machine. First, you need to know your enemy. You have to see what the insurance companies see. You are legally entitled to 1 free credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. The only place you should go to get this is annualcreditreport.com. That is the official government-mandated site. Don't get tricked by other sites that promise a free score, but sign you up for a costly monthly subscription. Get your reports and go through them with a fine-tooth comb. Which brings us to step 2, hunt for errors. You would be shocked at how common mistakes are on credit reports. A misspelled name, an account that isn't yours, a debt that was already paid off but is still showing as outstanding. I once helped a friend who found a collection account on his report for a Robert Jones, when his name was Robert Johnson. That single error from a clerical mistake was crushing his score. We filed a dispute online through the credit bureau's website, provided his documentation, and within 30 days, the error was removed. His score jumped 60 points, and he immediately shopped for new insurance, saving over $600 a year. Scrutinize every single line item on your report. If something looks wrong, dispute it immediately. Costs you nothing but a bit of your time. Step 3 is to master the 30% rule. This is about something called credit utilization, which is just a fancy term for how much of your available credit you're using. This is the second biggest factor in your score after payment history. The golden rule is to keep your balance on every single credit card below 30% of its limit. So if you have a card with a $10,000 limit, you never want the statement balance to be more than $3,000. If it's a $1,000 limit, keep the balance below $300. To lenders and insurers, a person who has maxed out their credit cards looks like they're in financial distress and therefore a higher risk. Lowering your utilization is the fastest way to boost your score. If you have multiple cards, focus on paying down the one with the highest utilization percentage first, the one closest to its limit. Step 4 is the most important of all. Make on-time payments always. Your payment history is the king of your credit score, accounting for about 35% of it. One single late payment that's more than 30 days past due can stay on your report for 7 years and can drop your score by over 100 points overnight. The damage is severe and long-lasting. The easiest way to avoid this is to set up automatic payments for at least the minimum amount due on every single one of your accounts. Even if you can only pay the minimum, paying it on time is infinitely better than paying the full balance a week late. Protect your on-time payment record like it's gold. Finally, step 5 is a bit counterintuitive. Don't close your old credit cards. Many people think that once they pay off a card, they should close the account to be responsible. This is a huge mistake. A significant part of your credit score is determined by the average age of your accounts. The longer your credit history, the better. When you close your oldest credit card, you're essentially erasing your longest-standing proof of creditworthiness. This shortens your credit history and can cause your score to drop. Plus, closing a card reduces your total available credit, which can instantly increase your overall credit utilization ratio, hurting your score even more. So, unless the card has a ridiculous annual fee, keep that old, paid-off account open. Use it once every 6 months for a small purchase like a coffee, and pay it off immediately. This keeps the account active and working in your favor. By checking your report for errors, keeping your balances below 30%, paying on time without fail, and preserving your oldest accounts, you are taking back control. You're not just building a better financial future, you are actively lowering your perceived risk in the eyes of insurers. It might take a few months for these changes to fully reflect in your score, but the payoff is enormous. We're not talking about saving $5 a month. We're talking about moving from Sarah's $175 premium to Jessica's $90 premium. That's real money back in your pocket month after month. But your credit score is only one piece of the puzzle. There's another piece of personal information on your application that can swing your rates by hundreds of dollars. Most people think it's set in stone, but a tiny one-word change, a change that is 100% legal and honest, can unlock a completely different tier of pricing. And it has to do with what you do for a living. Let's unpack that. Your profession, in the eyes of an insurance underwriter, is a proxy for your personality, your habits, and your risk. They have decades of data telling them that statistically teachers get into fewer accidents than, say, journalists who are always rushing to a story. Librarians are seen as safer bets than bartenders who work late nights. It's not a personal judgment. It's a cold, hard actuarial calculation. And this is where you can be smart. The key is that many of us have job titles that are vague, trendy, or don't fully capture what we do. And we often have more than one accurate way to describe our profession. Your goal is to find the most favorable, yet still completely honest description of your job. This isn't about lying. Let me be crystal clear. You should never, ever lie on an insurance application. That's fraud, and it can void your policy when you need it most. This is about strategic honesty. It's about choosing the right word from a list of equally true words. Let's take an example. Meet Sarah. Sarah is a content creator. That's what it says on her business card. It's what she tells people at parties. When she gets an auto insurance quote, she types in content creator. The algorithm sees that title and might lump her in with photographers, journalists, or videographers, people who might be driving all over town with expensive equipment, rushing to shoots, working erratic hours. The result? A higher premium. But what does Sarah actually do? She spends 90% of her time at a desk in her home office, writing and editing articles for websites. She is, by definition, a writer. She is also an editor. She could even be considered a marketing specialist. All of these are 100% accurate descriptions of her job. So Sarah gets curious. She goes back to the quote form. First, she tries writer. Her quote drops by $18 a month. Interesting. Then she tries editor. The quote drops by $25 a month. Better. Finally, she tries marketing specialist. Boom. Her annual premium plummets by over $400. Why? Because in the insurance company's database, a marketing specialist is statistically more likely to be an office worker with a stable 9-to-5 schedule, a lower risk profile than the ambiguous, on-the-go content creator. Sarah hasn't lied. She has simply chosen the most financially advantageous, truthful label for her profession. This applies across almost every industry. Are you a chef? Or are you a kitchen manager? A manager sounds more responsible, more stable. Are you a software developer? Or are you an IT consultant? One sounds like a creative type, the other like a corporate professional. Are you a salesman? That implies you're on the road constantly, racking up miles and risk. But what if your title is officially account executive, and you primarily work from an office? That one change could save you a fortune. The ambiguity works in your favor. Companies today use all sorts of creative titles. You might be a customer success ninja or a growth hacker. Insurance quote forms don't have boxes for those. You are forced to translate your modern title into their old school categories. So do it strategically. A customer success ninja is really a customer service representative. A growth hacker is a marketing manager. Think about the core function of your job and find the most stable, office-based, low-risk sounding title that accurately reflects it. Here's your action plan. First, write down your official job title. Then, brainstorm at least 5 other titles that honestly describe what you do. Think about your duties, not just your title. Do you manage people? You might be a manager or supervisor. Do you work with data? You could be an analyst. Do you work from home? Maybe office administrator is more accurate than a title that implies travel. Next, go to a few online quote comparison sites. Run the quotes with your current title. Note the price. Then go back and run the exact same quote, changing nothing else but the job title. Try each of the alternatives you brainstormed. You will be amazed at the difference a single word can make. I've seen people save over $800 a year with this method alone. This even applies if you're not currently employed. If you enter unemployed into a quote form, the system flags you as a higher risk. The data suggests that unemployed individuals may drive more during the day, running errands, going to interviews, and are potentially more financially strained, which statistically correlates with higher claims. But what if you're a stay-at-home parent? You're not unemployed, you're a homemaker. That one change can have a massive positive impact on your rate. The same goes for students. Unemployed is a red flag. Student is a recognized lower-risk category, especially if you qualify for a good student discount. The system is built on categories and classifications. It's impersonal, doesn't know you. It only knows the data associated with the words you type into the box. It doesn't understand nuance. A freelance artist might sound risky, unstable income, erratic schedule. But a graphic designer working on a contract basis sounds like a standard professional. They could be the exact same person. So I urge you, look at your job title not as a fixed label, but as a flexible descriptor. You're not changing who you are or what you do. You're simply translating your reality into the language of insurance underwriting. You are reframing your professional identity to fit into a more favorable statistical box. It's one of the easiest and most powerful ways to take control of your insurance costs without changing a single thing about your life or your driving habits. It's about being smarter than the form in front of you. But even if you get your job title perfect, the single biggest factor after your driving record is sitting in your driveway. And I'm not just talking about having a sports car versus a minivan. There's a hidden list of the most and least expensive cars to insure, and the reasons will shock you. It has very little to do with the sticker price and everything to do with a secret metric most drivers have never even heard of. That secret metric is called the Insurance Loss History Report. It's not something you'll see on a window sticker. It's not something the salesperson will ever mention. It's the insurance industry's internal report card for every single car model on the road, and it's the single biggest factor in determining your premium, often even more than your own driving record. This report doesn't care if a car costs $20,000 or $100,000. It answers 3 brutally simple questions. How often does this exact model get into an accident? When it does, how much does it cost to fix? And how often does it get stolen? The answers to these questions create a risk profile that can make a budget-friendly sedan more expensive to insure than a luxury SUV. Let's look at the real-world list. For years, one of the most expensive vehicles to insure has been the Maserati Ghibli. No surprise there, it's a high-performance Italian luxury car. But right alongside it on that most expensive list, you'll often find cars like the Kia Rio, the Hyundai Accent, and the Honda Civic. Wait, what? Aren't those economy cars? Exactly. On the flip side, some of the least expensive vehicles to insure are often models like the Subaru Outback, the Honda CR-V, and even the Tesla Model Y. A Tesla, a car known for its high-tech, expensive components, is cheaper to insure than a basic Kia? How is that possible? It's because the sticker price is a lie when it comes to insurance. The real cost is hidden in the data. Let's break down exactly why this happens, because understanding this is like getting a cheat code for car buying. The first reason is repair costs, but not in the way you think. You might assume a cheaper car has cheaper parts. That's a dangerous assumption. Many modern economy cars are built with highly integrated parts. That plastic bumper on a new Hyundai isn't just a piece of plastic anymore. It's a complex shell housing sensors for lane keep assist, blind spot monitoring, and automatic emergency braking. A minor 5-mile-per-hour parking lot tap that used to be a $300 cosmetic fix is now a $2,500 repair to replace and recalibrate a suite of sensors. Insurers see this data in real time. They know that a minor claim on a 2023 Kia Forte can cost more than a similar claim on a 2018 Lexus RX 350, because the Lexus parts are widely available and the technology is more established. The insurer isn't pricing your policy based on the car's value. They're pricing it based on the average cost of their claims for that specific model. The second, and more dramatic reason is theft. This is the story of the Kia Boys phenomenon that blew up on social media. For years, certain models of Kia and Hyundai cars were built without a critical anti-theft device called an engine immobilizer. It was a cost-saving measure. This tiny missing chip made these cars astonishingly easy to steal with nothing more than a USB cable. The result? A nationwide explosion in thefts targeting these specific models. Insurance companies were hemorrhaging money, paying out claim after claim for stolen Kias and Hyundais. What did they do? They jacked up the premiums on those models to astronomical levels. In some cities, owners saw their insurance rates triple overnight. Some insurers even refused to cover these cars at all, leaving owners stranded with a car they couldn't legally drive. This is a perfect, brutal example of how a car's inherent vulnerability, something you'd never know from a test drive, can make it financially toxic to own. Your personal driving record could be spotless, but if you own a car that's on a thief's top 10 list, you are going to pay a massive theft tax on your insurance. The third factor is the safety paradox. We all want a safe car. Cars with high safety ratings from the Insurance Institute for Highway Safety, or IIHS, should be cheaper to insure, right? Yes and no. This is where it gets tricky. A car with incredible safety features, like 12 airbags and a reinforced steel frame, is fantastic at protecting its occupants. This means insurers are less likely to pay out huge medical claims for injuries, which is a massive plus. They love that. However, the very technology that saves lives can be incredibly expensive to repair. That windshield with the heads-up display and integrated camera for the lane departure system? That's not a $400 windshield anymore. It's a $2,000 piece of technology that requires professional recalibration. So the insurance company has to perform a delicate balancing act. They weigh the reduced risk of paying for your hospital bills against the increased certainty of paying for an eye-wateringly expensive repair bill for a minor accident. The sweet spot, the cars that are cheapest to insure, are the ones that are very safe but are also built with reasonably priced, readily available parts. Think of a Subaru Forester. It's an IIHS top safety pick year after year, but its parts are everywhere, and the repair network is vast. It hits that perfect balance. Finally, there's the unspoken reality of the typical driver profile. Insurers are masters of data, and they build a profile for the type of person who typically buys a specific car. A Subaru WRX or a Dodge Charger, for example, tends to attract a younger, more aggressive driver. The data shows these cars are involved in more at-fault, high-speed accidents. It doesn't matter if you are a 55-year-old librarian who drives your Charger to the grocery store once a week. You are paying a premium based on the aggregated sins of thousands of other Charger drivers. Conversely, a minivan like a Honda Odyssey or a Volvo station wagon is typically driven by a safety-conscious parent. The driving style is more defensive, the trips are often local, and the accident data reflects that. The car you choose broadcasts a signal to the insurance company about the kind of driver you are likely to be, even before they look at your personal record. So, how do you use this insider knowledge to your advantage? It's simple, but it's the one step 99% of car buyers skip. Before you fall in love with a car on the lot, before you even take a test drive, you must get an insurance quote for it. Treat the insurance premium as part of the car's sticker price. A car that's $2,000 cheaper than its competitor might cost you an extra $80 a month to insure. Over a 5-year loan, you've just paid over $4,800 extra for the cheaper car. You've completely wiped out your savings and then some. Here's the pro move. When you've narrowed your choice down to 2 or 3 models, call your insurance agent or use an online quote tool. Get a hard quote for each specific vehicle, using its vehicle identification number, or VIN, from the dealer's website. Compare them side by side. The results will absolutely shock you, and will make your decision crystal clear. And if you want to do your own research, go to the website for the IHS, the Insurance Institute for Highway Safety. They publish loss data that is broken down by vehicle model. You can see in plain black and white which cars are substantially better than average, and which are substantially worse than average when it comes to collision, property damage, and theft claims. Spending just 20 minutes on this website before you go car shopping can save you thousands of dollars over the life of your vehicle. Choosing the right car isn't just about color or horsepower. It's the biggest strategic decision you can make to control your insurance costs for years to come. But what if you already own your car, and you're stuck with a model that's more expensive to insure? Don't worry, you are not powerless. The car is just one piece of the puzzle. The next lever you can pull is one that insurance companies bank on you never fully understanding: the massive, confusing, and often hidden world of discounts. They have a menu of dozens of potential discounts, but they won't just hand them to you. You have to know they exist, and you have to ask for them specifically. In fact, you're probably eligible for at least 3 of them right now that you're not getting. And the next tip is the one that saved me over $300 a year with a single 5-minute phone call. I called my insurance company, the one I'd been with for 7 years, and I asked them about bundling my auto insurance with my renter's insurance. That's it. That was the magic question. Now I know what you're thinking. Bundling? That's the big secret. And the answer is yes and no. It's the starting point, the Trojan horse that gets you inside the gates, but the real savings, the big money, comes from what you do after you ask that question. Let me walk you through exactly what happened on that call, because it was a masterclass in how these companies operate. I dialed the number, got a friendly agent on the line, and said, "Hi, I've been a happy customer for a while now, and I was just calling to see if I could get a discount for bundling my renter's insurance with my auto policy." The agent's tone immediately brightened. "Of course. We love our loyal customers. Let me just pull up your account." He spent maybe 2 minutes typing, and then came back with the good news. "Okay, sir, it looks like by adding a renter's policy, which will only cost you about $12 a month, we can apply a multi-policy discount that will save you $20 a month on your auto insurance." Now let's pause right there. That's already a win. I'm getting renter's insurance, which I needed anyway to protect my stuff, for essentially free, and I'm saving an extra $8 a month. That's about $100 a year in savings right there. Most people would hear that, say, "Great, sign me up," and hang up the phone feeling like a genius. And you would be. You'd have saved $100. But that's not the $300 I promised you. That's not even close. The real magic happened next. This is where we expose something called the loyalty penalty. It's one of the dirtiest little secrets in the insurance industry. You'd think that being a loyal customer for 7 years would mean you get the best possible rates, right? A reward for your business. Wrong. In many cases, it means you're paying more than a brand new customer walking in off the street. Here's why. Insurance companies spend a fortune on advertising to acquire new customers. They offer incredibly low introductory rates to get you to switch. But how do they pay for those low rates? They do it by slowly, year after year, creeping up the premiums on their existing loyal customers. They raise it by $5 a month one year, $7 the next, hoping you're too busy to notice or too lazy to shop around. They are banking on your loyalty being a form of inertia. They are penalizing you for being their customer. So back to the phone call. After the agent told me about the $100 savings, I took a breath and said, "That's a good start, and I appreciate you finding that for me. But I have to be honest. I spent about 10 minutes online before this call, and got a quote from Progressive for the exact same auto and renter's coverage, and their price was still nearly $200 a year cheaper than your new bundled price. I've been with you guys for 7 years, I've never missed a payment, never had an at-fault accident. I really don't want to go through the hassle of switching, but it's just a lot of money to leave on the table. Is there anything else you can do to get closer to that price for me?" The silence on the other end of the line was deafening. It was just for a second, but I could feel the entire dynamic of the call shift. I was no longer just a passive customer accepting a discount. I was an informed consumer with a better offer, politely threatening to walk. The agent's tone changed from cheerful to serious. "I see," he said. Let me put you on a brief hold. I'm going to go talk to my manager and see if there are any other discounts we might have missed." He put me on hold, and I listened to that terrible hold music for about 3 minutes, my heart pounding a little. This was the moment of truth. Was he going to call my bluff? Was he going to come back and say, "Sorry, that's the best we can do"? He came back on the line. "Thank you for holding, sir." So I was able to talk to my manager, and you're right. As a long-term customer with a perfect driving record, you absolutely deserve our best rate. It looks like we failed to apply a preferred customer loyalty credit to your account. My apologies for that. With that credit applied on top of your multi-policy discount, it looks like we can actually beat the competitor's quote by about $10. How does that sound? And there it was. One polite 5-minute phone call. The first 2 minutes got me $100 in savings from the bundle. The next 3 minutes, where I used a competitor's quote as leverage, got me an additional $200+ in savings from a magical loyalty credit that they only give to people who ask for it. That's over $300 a year every single year, for the rest of the time I'm with that company. This is so incredibly powerful, and you can do the exact same thing. Here is your step-by-step plan. First, before you do anything else, go to a competitor's website, Progressive, Geico, any of them, and get a full apples-to-apples quote for the same coverage you have now. It will take you 15 minutes tops. Save that quote. That number is your leverage. It's your silver bullet. Second, call your current insurance provider. Don't just switch. Always give them a chance to keep you. It's less hassle for you, and you might be surprised what they'll do when their feet are to the fire. Third, use the script. Start friendly. Ask about bundling. If you own a home, bundle your homeowner's insurance. If you rent, bundle your renter's insurance. If you have neither, ask if they offer it, because sometimes the discount on your auto policy is so large it literally makes the renter's policy free. You get free protection for your belongings. After they give you the initial bundle discount, you pause and then you deliver the knockout blow politely. Thank you, I appreciate that. However, I do have a quote here from competitors named the lower price. I've been a customer for a number of years and I'd really prefer to stay, but that's a significant difference. Is there any way you can match that price for me? And then you stop talking. Let them be the next one to speak. Now, some of you might be thinking, what if they say no? What if they call my bluff? Well, then you say, okay, I understand. Thank you for your time. And you hang up and you switch to the competitor who is already offering you a better price. It is a situation where you cannot lose. Either your current company lowers your rate significantly, or you switch to a new company that is already cheaper. The only way you lose is by not making the call at all. This strategy works because the insurance companies know a secret. The cost to acquire a new customer is astronomically high. They spend billions on ads with cavemen and talking geckos. It is far, far cheaper for them to give you a $200 discount to keep you than it is to lose you and have to spend $500 in marketing to replace you. You have all the power in this negotiation, you just have to know how to use it. Bundling is your key to open the door, and the competitor quote is your key to the vault. And while making a single phone call can save you hundreds, the next tip is something you can do without talking to a single person. It's a silent, invisible factor that could be costing you over $1,000 a year on your insurance, and most people have no idea it's even being used against them. In fact, in some states it impacts your rate more than a DUI does. And that factor, the one that can have a bigger impact on your insurance bill than a drunk driving conviction, is your credit score. Now hold on. Before you click away thinking, oh great, another finance lecture, you need to understand this isn't about getting a mortgage or a new credit card. This is about a secret parallel score the insurance industry has created just for you. It's called a credit-based insurance score. And it is one of the most powerful and frankly most controversial tools they use to decide how much you pay. In 47 states, it's completely legal for them to pull data from your credit report and use it to predict how likely you are to file a claim. Their logic, backed by their own internal studies, is that how you manage your money is a powerful predictor of how you manage your life, including how you drive. A person who pays their bills on time, keeps their debt low, and manages their finances responsibly is, in their eyes, statistically less likely to get into an accident, less likely to file a frivolous claim, and more likely to maintain their vehicle properly. On the other hand, someone with a history of late payments, maxed out credit cards, and multiple collections accounts is seen as a higher risk. The data suggests they're more likely to file claims, more likely to miss a premium payment, and maybe even more likely to commit insurance fraud out of financial desperation. Now, is that fair? Is your FICO score a true reflection of your skills behind the wheel? That's a massive debate. In fact, states like California, Hawaii, and Massachusetts have banned the practice entirely, arguing it unfairly penalizes lower-income individuals, young people building credit, or anyone who's hit a rough patch like a medical emergency or a job loss. But for the vast majority of Americans, this is the reality we live in. Your financial history is directly tied to your car insurance premium. And the difference isn't just a few bucks. It's staggering. According to a study by Value Penguin, a driver with poor credit pays, on average, 114% more than a driver with excellent credit. Let me put that in real numbers. If the base rate for a driver with excellent credit is $1,500 a year, that same exact driver, same car, same address, same clean driving record, could be quoted over $3,200 a year simply because of a low credit score. That's an extra $140 a month for nothing. You're being charged for a risk you might not even represent. Think about two identical twins. Let's call them Mark and David. They live next door to each other, drive the same model Toyota Camry, and have never had so much as a speeding ticket. But Mark, ever since he was 18, was diligent. He paid his student loan bills on time, kept the balance on his one credit card low, and never missed a payment. David, on the other hand, was a bit more carefree. He missed a few payments in college, maxed out a couple of store cards to buy some new tech, and co-signed on a car loan for a friend who then defaulted. When they both call the same insurance company for a quote, Mark gets a rate of $120 a month. David, with his spotty credit history, is quoted $250 a month. For the exact same coverage, David is paying over $1,500 more per year, not because he's a bad driver, but because an algorithm decided his financial past makes him a future liability. He's paying a bad driver tax without ever having driven badly. So this brings us to smart way number 6. Proactively manage and repair your credit to slash your insurance rates. This isn't a quick fix, but it is by far one of the most powerful long-term strategies to permanently lower what you pay. It's about playing their game and winning. So how do you do it? It boils down to 3 critical steps. First, you have to know what they know. You need to see what's on your credit report. By law, you are entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once every year. The official government-mandated site for this is annualcreditreport.com. Don't go to those other sites with the catchy jingles. They're often trying to sell you something. Go to the official one. Pull all 3 reports and go through them with a fine-tooth comb. You are looking for errors. A misspelled name, an account that isn't yours, a late payment that you know you made on time. One study by the Federal Trade Commission found that 1 in 5 consumers had an error on at least one of their credit reports. 1 in 5. That error could be the very thing that's bumping you down a tier and costing you hundreds of dollars. If you find an error, dispute it immediately with the credit bureau. They are legally obligated to investigate. Second, you need to focus on what matters most. While your full credit report is complex, your score is primarily driven by a few key factors. The single biggest one, making up about 35% of your score, is your payment history. This is non-negotiable. You must pay every single bill on time every single time. Even one 30-day late payment can crater your score and stay on your report for 7 years. Set up autopay for everything. Your credit card, your student loan, your car payment, your utility bills. Make it impossible to forget. The next biggest factor, worth about 30% of your score, is your credit utilization ratio. This sounds complicated, but it's simple. It's how much of your available credit you're using. If you have one credit card with a $10,000 limit and you have a $5,000 balance, your utilization is 50%. To lenders and insurance companies, a high utilization ratio screams financial distress. It looks like you're living on the edge. The golden rule is to keep your overall utilization below 30%. But if you really want to see your score jump, aim for under 10%. This is a powerful lever because you can change it in a single month. Paying down your balances is the fastest way to do this. Another trick is to ask for a credit limit increase on your existing cards. If your limit goes from $10,000 to $20,000, that $5,000 balance suddenly drops your utilization from 50% down to just 25%, instantly boosting your score without you spending an extra dime. Third, play the long game. The age of your credit history makes up about 15% of your score. Lenders and insurers like to see a long, stable history of responsible borrowing. This means you should avoid closing your oldest credit card accounts, even if you don't use them much anymore. Closing that old card you got in college might feel like simplifying your life, but it can actually hurt you. It erases a long-standing account from your report, which can shorten the average age of your credit history and lower your score. Instead, just use it once every 6 months for a small purchase like a coffee, and pay it off immediately. That keeps the account active and working for you. By focusing on these 3 areas, checking for errors, paying on time, and keeping your balances low, You are directly manipulating the very data the insurance companies use against you. As your score improves, you don't have to wait for your renewal. You can call your insurance company in 6 months and say, "My financial situation has improved significantly, and I'd like you to rerun my insurance score and requote my policy." Many will do it, and the savings can be immediate. You are taking back control from the algorithm. This isn't just about saving money on car insurance. A better credit score will save you tens, or even hundreds of thousands of dollars over your lifetime on everything from car loans to mortgages. But starting with your insurance is a fantastic motivator, because it's a bill you pay every single month. Seeing that number drop is a tangible reward for your financial discipline. Fixing your credit is a powerful long-term play. But what if I told you there's a simple conversation you can have today? A 5-minute phone call that could instantly unlock a whole suite of discounts you didn't even know existed? Most agents won't offer them, and they're not listed on the website. They are reserved for the people who know to ask and, more importantly, know how to ask. You have to use a few magic words. The first magic word is an abracadabra. It's not a secret code. It's a fundamental shift in how you approach the conversation. You see, when most people call their insurance company, they sound one of two ways: angry or desperate. They either yell, "My rate went up again. This is ridiculous." Or they plead, "Please, is there anything you can do to lower my bill? I can't afford this." Both of these approaches put the agent on the defensive. They've heard it 1,000 times. Their brain immediately shifts into a pre-programmed script designed to calmly explain why your rates went up and why there's nothing they can do. You've already lost. The magic words, the ones that unlock the hidden discounts, are the ones that flip that script. They signal to the agent that you are not an average, uninformed customer. You're what they call in the industry an educated consumer. And they have a completely different playbook for you. Let me tell you about a guy named David. David is probably a lot like you. He's a good driver, no accidents, no tickets in years. He's been with the same insurance company, let's call them All-American Mutual, for 8 years straight. He set up autopay and just let it run, figuring his loyalty would be rewarded. But every 6 months he'd get that email with his new policy documents, and every 6 months the number was a little bit higher. First it was $10, then $20. This last time it was a $45 jump. For what? Nothing had changed. Same car, same commute, same clean record. David was frustrated. He did what most of us do. He called All-American Mutual, waited on hold for 20 minutes listening to terrible music, and finally got a representative. He explained his frustration. The agent, a perfectly nice but clearly scripted person, gave him the standard lines. "Well, sir, rates in your area have increased due to inflation and rising repair costs." David got nowhere. He hung up feeling defeated, ready to just accept the increase. But then he learned the script. He learned the magic words. A week later he called back, but this time he was a different man. He wasn't David, the frustrated customer. He was David, the educated consumer. Here's exactly what he did and what you need to do. This is the 7th smart way to find cheap auto insurance. Master the retention script. When the agent answered the phone, David didn't complain. He was calm, polite, and professional. He started with the first magic phrase. He said, "Hi, my name is David, and I'm calling today to conduct a full review of my policy to identify any potential cost-saving opportunities." Let's break that down. He didn't say lower my bill. He said conduct a full review, which sounds official and collaborative. He didn't say my bill is too high. He said identify cost-saving opportunities, which frames it as a mutual goal. This language immediately tells the agent, okay, this person is serious. This isn't a typical complaint call. The agent's posture changes. They sit up a little straighter. Next, David played the loyalty card, but with a twist. He said, "I've been a loyal customer with All-American Mutual for 8 years now, and my strong preference is to stay with you. I've always been happy with the service. This is brilliant." He's complimenting them while simultaneously reminding them of his long-term value. He's not threatening to leave, not yet. He's saying, "I'm on your team. I want to give you my money. Help me find a way to do it." Every insurance company's #1 goal, even more than signing up new people, is retention. Keeping existing customers is far more profitable. David just made himself the agent's project for the day. Keep this 8-year customer happy. Now comes the pivot, the part that applies the pressure. David continued, "However, as part of my regular financial review, I've been getting quotes from other insurance carriers, and I have to be honest, I've received some significantly more competitive offers for the exact same coverage. Boom. That's the trigger. He didn't say who the competitor was. He didn't say the exact price. He didn't have to. He just introduced the idea of competition. This is the moment the agent's internal monologue switches from customer service to customer retention. They know he's been shopping. They know he has a walk-away number in his head. The game has changed. The agent will typically respond with something like, "Okay, sir, let me see what I can do. Let me pull up your account." This is where you move to the next phase of the script. David waited patiently, and when the agent came back, he preempted them. Before they could give him another excuse, he said, "I'd appreciate it if we could go through my policy line by line to ensure I'm receiving every single discount I'm eligible for. I've heard there are often discounts that aren't automatically applied. This is a power move." He's not just asking, "Do you have any discounts?" He's directing the call. He's telling the agent how to do their job. And he's hinting that he knows about the existence of unlisted, ask for it discounts. Then David started asking specifically. He said, "For example, I'm a college graduate. Is there an alumni discount applied to my account? I'm also a member of a few professional organizations. Do any of those qualify me for a discount? My car has a factory-installed anti-theft system. Is that being accounted for? And with my job, I'm now working from home 3 days a week, so my annual mileage has dropped significantly. Can we adjust my mileage estimate for a low mileage discount?" He was pulling out discounts the agent might never have offered. He was demonstrating that he had done his homework. Each question was another signal that he was not someone who could be easily dismissed. The agent, now actively trying to keep David's business, started typing furiously. "Okay, yes, I see we can add the alumni discount. Let me check on the professional organizations. Yes, looks like we can apply a 5% discount for the anti-theft system. Let me just recalculate your premium with those changes." After a few minutes, the agent came back with a new lower number. Let's say it was $25 less per month. Now this is where 99% of people would say, "Great, thank you," and hang up happy they saved anything at all. But David wasn't done. He was following the script. He used the final, most powerful phrase in negotiation. He said it politely, without an ounce of arrogance. "Thank you so much for finding those savings. I really do appreciate you taking the time to do that. That definitely helps." To be fully transparent though, it's still not quite at the level of the other quotes I've received. Is this new price the absolute best you can do for a loyal customer of 8 years? That's the kill shot. Is this the absolute best you can do? You've been polite, you've been reasonable, you've shown you're informed, and now you're asking for their final best offer. This question often unlocks a different level of authority. It might prompt the agent to seek a manager's approval, or apply a one-time loyalty credit that they are empowered to use but only in situations where they are about to lose a valuable customer. The agent on the phone with David said, "Please hold one moment, sir." This was the longest hold of the call. David's heart was pounding a little. He was wondering if he'd pushed too hard. 2 minutes later, the agent came back on the line. "Mr. David, thank you for your patience. I was able to speak with my supervisor, and given your excellent driving record and your 8-year history with us, we've been authorized to apply an additional valued customer loyalty discount to your policy. It looks like your new monthly premium will be..." The final number was $55 less than his original renewal quote. $55 a month. That's $660 a year. David didn't just stop the $45 increase. He slashed his bill well below what it was before. All because he stopped being a frustrated customer and started being an educated consumer. He used the script. He used the magic words. It's not about what you ask for, it's about how you orchestrate the entire conversation to make them fight to keep you. But what happens if you do all this, you follow the script perfectly, and the agent just says no? What if they call your bluff and say, "I'm sorry sir, that's the final price"? Most people hang up defeated at this point, thinking they've hit a brick wall. But they haven't. There's one more ace up your sleeve, a department even more powerful than retention, an option that can completely change the game. It's the one thing they don't want you to know about. It's called the Executive Escalations Team, or sometimes the Office of the President, or the Customer Advocacy Group. The name changes from company to company, but its function is the same. It is the final backstop. It is the court of last resort, staffed by senior-level employees who have one primary directive: solve complex problems that frontline agents can't. And more importantly, they have the authority to do what others can't. They can authorize a full, manual, human-led underwriting review of your policy. This is the key. This is the entire game. You see, the price you're quoted for car insurance isn't really decided by a person. It's decided by an algorithm, a cold, calculating piece of software that takes dozens, sometimes hundreds of data points about you. Your age, your zip code, your car, your credit history, your marital status, and it feeds them into a complex formula. It doesn't know you. It doesn't know you park in a secure garage every night. It doesn't know that even though you live in a zip code with a slightly higher claim rate, you've never had so much as a parking ticket in your life. The algorithm doesn't care about your story. It only cares about the data. And sometimes the data tells the wrong story. Retention specialists can tweak the numbers. They can apply pre-approved loyalty discounts. They can find a coupon here or a special promotion there. But they cannot change the fundamental calculation. They are working within the rigid box that the algorithm has created for you. The executive escalations team, however, can step outside the box. They can ask the one department that created the box in the first place, the underwriters, to take a second look. To use human judgment, let me tell you about a woman named Sarah. Sarah was a 35-year-old nurse with a spotless driving record. 12 years on the road, not a single at-fault accident, not a single ticket. She drove a sensible, safe Honda CR-V. By every measure, she was the perfect customer. Yet, when her renewal came up, her premium had skyrocketed by nearly 40%. She did everything right. She called her insurance company. The first agent was polite but useless, reading from a script about rising costs in her area. She asked for the retention department. The retention specialist was better. He was empathetic. He found a small discount for her being a healthcare worker, and another one for bundling her renter's insurance. It knocked the price down, but only by about 8%. It was still a massive, unjustified increase. He explained, "Ma'am, your zip code has seen a significant increase in auto theft and collision claims this past year. Our system has automatically adjusted the risk profile for the entire area." Sarah was stunned. She lived in a large, new apartment complex with gated, underground parking. She wasn't parking on the street. Her personal risk of theft was incredibly low, but the algorithm didn't know that. It just saw her zip code, lumped her in with everyone else, and slammed her with a higher rate. The retention specialist sympathized, but his hands were tied. "I'm sorry," he said. "The rate is the rate. I've applied all the discounts I'm authorized to give. This is the brick wall. This is where 99% of people give up, sigh in frustration, and either pay the new premium or start the exhausting process of shopping around all over again." But Sarah had heard about the ace up her sleeve. She took a deep breath and said the magic words. She didn't yell. She wasn't rude. She was calm, firm, and professional. She said, "I understand your position, and I appreciate the discounts you found for me. However, I believe the algorithm is inaccurately assessing my individual risk profile. It is penalizing me for broad-stroke geographical data that does not apply to my specific situation. I would like to formally request a manual underwriting review of my policy." Silence on the other end of the line. The agent was likely floored. These are not words they hear every day. He probably had to put her on hold to ask his supervisor what to do, because a request like this is a signal. It signals that you are not an average customer. It signals that you have done your research, and you are not going to be placated by a $10 a month loyalty discount. It signals that you are prepared to escalate the issue. The retention specialist came back and said that wasn't a standard procedure. This is the second test. They will almost always try to shut it down. Sarah was prepared. She calmly replied, "I understand it may not be standard, but my situation is unique. If you are unable to initiate that review for me, could you please transfer me to someone in your executive escalations office, or provide me with the formal process for filing a complaint with a senior case manager?" Checkmate. The phrases executive escalations and formal complaint are internal trigger words. They activate a different protocol. The company knows that an unhappy customer who knows these terms is a customer who is one step away from filing a complaint with their state department of insurance or blasting the company on social media. The cost of dealing with a formal regulatory complaint is vastly higher than the cost of having an underwriter spend 30 minutes looking at a file. The transfer was made. Sarah found herself talking to a woman named Brenda from the office of the CEO. The tone was completely different. Brenda wasn't a salesperson. She was a problem solver. Sarah explained her situation again, but this time she was prepared with a case file. She laid out the facts: her 12-year perfect driving record, which she had a copy of from the DMV, the safety features of her specific vehicle model, and the key piece of evidence: a letter from her apartment complex management confirming her assigned spot in their 24/7 monitored, keycard access-only underground garage. She wasn't just complaining about her rate. She was presenting a logical, evidence-based argument that the computer had gotten it wrong. Brenda listened patiently, took notes, and said, "Thank you for bringing this to our attention, Ms. Miller. I agree that your situation warrants a closer look. I am sending your file to a senior underwriter for a manual review and reevaluation. We will contact you within 3 to 5 business days with an update." For days later, Sarah got an email. It was from Brenda. The underwriter had reviewed her file, her driving history, and the information about her secure parking. They had agreed that the standard algorithm for her zip code was not an appropriate measure of her actual risk. They had applied what's called an underwriting exception, essentially a human override of the computer's decision. Her new renewal premium wasn't just back to the original price. It was actually 7% lower than what she had been paying the previous year. They had not only reversed the unfair increase, but they had reclassified her as the premium low-risk client she truly was and rewarded her for it. Now let's be crystal clear. This strategy is not for everyone. If your rates are high because you have 3 speeding tickets and 2 at-fault accidents, a manual review is just going to have a human being confirm what the computer already knows: you're a high-risk driver. This is a precision tool, not a blunt instrument. This is for the people who fall through the cracks of the algorithm. It's for the driver with a pristine record who happens to live on the wrong side of a zip code boundary. It's for the person who owns a rare or classic car that the system miscategorizes. It's for anyone who has a legitimate, evidence-based reason to believe that the computer's broad assumptions do not reflect their individual reality. So how do you do it? First, build your case. Don't just call and complain. Gather your evidence. Get a copy of your driving record. Document your security measures like a garage or anti-theft devices. If you have a telematics app that shows you're a safe driver, have those reports ready. Second, call and calmly work your way through the channels. Be polite but firm. Use the key phrases, manual underwriting review, and inaccurately assessing my individual risk profile. Third, if you meet resistance, ask for the executive escalations team or the office of the president. And finally, when you get there, don't deliver a complaint. Deliver a presentation. You are your own lawyer and the underwriter is the judge. Give them the evidence they need to rule in your favor. By doing this, you are fundamentally changing the dynamic. You are moving from a passive price taker to an active participant in your own risk assessment. You are forcing the insurance company to see you not as a data point, but as an individual. And in a world run by algorithms, that is the most powerful move you can make. You've learned how to fight the algorithm, how to appeal to a higher authority and get a human review. But what if I told you there's a way to make the algorithm your best friend? A way to get rewarded for things you're already doing. Unlocking discounts so hidden, they're not even listed on the company's website. We're about to go from defense to offense. And that offensive playbook has a name. It's called usage-based insurance, or UBI. But that's the boring industry term. You probably know it by its nicknames. Snapshot from Progressive, DriveWise from Allstate, Drive Safe and Save from State Farm. You've seen the commercials. It's that little device you plug into your car, or the app you download on your phone, that tracks your driving habits. And for years, most of us have viewed it with suspicion. A spy in the car. A black box that reports our every move back to corporate headquarters. We've been trained to see it as a tool for the insurance company. But that's the defensive mindset. The offensive mindset sees it for what it truly is. The single most powerful tool you have to prove your value as a customer. Think about it. For 100 years, auto insurance has been a game of averages and assumptions. They look at your age, your gender, your zip code, your credit score, and they lump you into a giant risk pool with thousands of other people who look like you on paper. You could be the safest, most cautious driver in a neighborhood full of reckless ones, but you pay a penalty because of your address. You could be a 22-year-old with the reflexes of a fighter pilot and the patience of a saint, but you pay a massive premium because, on average, other 22-year-olds are a liability. The system is fundamentally unfair because it judges you based on stereotypes, not on reality. It's based on who they think you are, not on who you actually are behind the wheel. Usage-based insurance flips that entire model on its head. It's a declaration to your insurance company that says, "Stop guessing. Stop using outdated statistics. I'm going to give you the raw, undeniable data that proves I am a low-risk driver, and you are going to pay me for it." You are no longer a passive number in their algorithm. You are an active participant, feeding it the exact information it needs to give you the rate you deserve. This is how you make the algorithm your best friend. You're not trying to trick it. You're giving it the truth. So how does this magic actually work? Simpler than you think. Whether it's a small device that plugs into your car's OBD2 port, that's the little port under your steering wheel that mechanics use, or an app that uses your phone's GPS and sensors, the system focuses on a few key behaviors. These are the make or break habits that statistically lead to accidents. First and most importantly is braking. Specifically, hard braking events. Slamming on your brakes is a massive red flag for insurers. It suggests you're not paying attention, you're following too closely, or you're consistently putting yourself in situations where you need to make an emergency stop. A good driver anticipates the flow of traffic. They see the yellow light from a block away and coast to a stop. A telematics device logs every instance of harsh braking, and the fewer you have, the better your score. The second is rapid acceleration. Peeling out from a stoplight might feel good, but to an insurance algorithm, it looks like aggressive, impatient, and wasteful driving. Smooth, gradual acceleration is the mark of a safe, predictable driver who is in control of their vehicle. It's not about driving slow. It's about driving smart. Third is cornering. Taking turns too fast, where the G-forces start to build up, is another sign of aggressive behavior. The app or device can feel this just like a passenger in your car would. Smooth, controlled turns show that you respect the laws of physics and the limits of your vehicle. Fourth is the time of day you drive. This one can feel a little unfair, but it's based on cold, hard data. Driving late at night, especially between midnight and 4 a.m., is statistically far more dangerous. There are more tired drivers, more impaired drivers, and lower visibility. If you're someone who primarily drives during daylight hours for your commute or errands, the system rewards you for avoiding those high-risk periods. And finally, there's mileage. This is the most straightforward factor. The less you drive, the less exposure you have to potential accidents. For people who now work from home, or who have a short commute, this is a massive source of savings that was previously hard to prove. Instead of just telling your insurer you drive 8,000 miles a year, you are now providing them with a certified log that proves it. Now let's address the elephant in the room: privacy. The big brother concern. Is my insurance company tracking my every move? Do they know I went to Taco Bell twice last week? The answer is no. And it's crucial to understand this distinction. They are not tracking where you go, but how you get there. They don't care about your destination. They care about the G-force spike when you took that off-ramp too fast. They don't care that you were in the pharmacy parking lot. They care that you slammed on your brakes to avoid a runaway shopping cart. Think of it less like a spy and more like a fitness tracker for your car. A Fitbit doesn't judge you for walking to the donut shop. It just counts the steps you took to get there. It's providing objective data on your performance. And here's the most important part. In most states and with most major companies, this data can only be used to help you. They offer it as a discount tool. They'll give you a baseline rate, and your good driving can only lower it from there. Many programs even have a trial period. You can test it out for a few months, see what your potential discount is, and if you don't like it, you can opt out with no penalty. You have all the power. The savings here aren't trivial. We're not talking about a 5% discount. Safe drivers using these programs can see their premiums drop by 20, 30, or in some cases even 40%. Imagine taking a $2,000 annual premium and slashing it down to $1,200. That's $800 back in your pocket every single year. And for what? For driving the way you already drive. For being the safe, responsible person you already are. You're not just saving money, you're getting validation. The system is finally recognizing your individual skill instead of just your demographic profile. This is the ultimate form of show, don't tell. For years, we've been telling our insurance companies we're good drivers. We check the box on the form that says, no accidents. We tell them we have a short commute. But it's just our word against their mountain of statistics. Telematics allows you to show them, to provide irrefutable digital proof. So who is this for? It's for the responsible commuter who leaves plenty of space in traffic. It's for the parent driving their kids to soccer practice, taking every turn with caution. It's for the retiree who only uses their car for errands during off-peak hours. It's for the young driver who wants to prove they're not a stereotype and escape the crushing rates assigned to their age group. It's for anyone who believes their actual driving habits are better than what their insurance company assumes. And who is it not for? Let's be honest. If you're a traveling salesperson who is constantly on the road, driving late at night to get to the next city, this might not be your best bet. If you have a bit of a lead foot and enjoy the thrill of rapid acceleration, this program will likely call you out on it. The key is self-awareness. But for the vast majority of drivers who are genuinely safe, it's a tool that's been criminally underutilized. Getting started is simple. Call your current insurance agent or go to their website and ask about their usage-based or telematics program. Ask them specifically if it can be used to raise your rates or if it's a discount-only program. Ask about the trial period. If it sounds good, sign up. They'll either mail you a tiny device you plug in yourself in about 10 seconds, or they'll direct you to download an app. Then just drive. For the first few weeks, be mindful. Notice your own habits. Are you braking a little too hard? Are you following a little too close? The app will give you feedback, a score, a report card on your driving. It gamifies the experience of being safe. You'll find yourself wanting to get a better score, not just for the discount, but for the pride of it. You are turning the tables. Instead of the insurance company holding all the cards and telling you what you're worth, you are sliding a folder across the table filled with data, charts, and evidence of your excellence, and you're telling them to give you the price you've earned. You've gone from being a defendant in their courtroom of risk to being the star witness for your own case. This is how you beat the system, not by tricking it, but by overwhelming it with the truth. But there's one final piece to this puzzle. One last strategy that ties everything together. It takes the comparison shopping we talked about, the discount stacking, the credit score optimization, and even this data-driven approach, and it combines them into a single powerful yearly ritual. It's the one thing that ensures you never, ever overpay for insurance again. It's the master key that unlocks the absolute lowest rate, year after year, and it's coming up next. I call this the annual insurance audit. And it's not just a tip, it's a system. A yearly financial ritual that turns you from a passive customer into the CEO of your own insurance policy. It's the single most effective strategy because it forces you to implement all the best practices we've talked about on a consistent, recurring schedule. Inertia is the insurance company's best friend and your wallet's worst enemy. The annual insurance audit is the cure for that inertia. So, how does it work? It's a simple 5-step process you'll perform once a year, every year, like clockwork. Step 1 is the simplest, but it's the foundation for everything else. Pull out your phone right now. Seriously. Open your calendar. Find the date your current auto insurance policy is set to renew. Now, go back exactly 45 days from that date. Create a new event. Call it Annual Insurance Audit or Shop for Car Insurance. And here's the most important part. Set it as a recurring event every single year. This 45-day window is the sweet spot. It gives you plenty of time to gather quotes without rushing, but it's close enough to your renewal that the quotes will be accurate. This single 30-second action creates the trigger that will save you thousands of dollars over your lifetime. It automates your proactivity. Step 2, when that calendar reminder pops up, is the personal review. Before you even think about getting a quote, you need to take stock of your life. Insurance pricing is a direct reflection of your life's data. So, has that data changed in the last 12 months? Sit down with your current policy declaration page and ask yourself a series of questions. Did I move? A new zip code can dramatically change your rates, for better or worse. Did I get a new job? Is my commute shorter? Driving fewer miles means less risk, which should mean a lower premium. Did I get married? That's a huge one. Married drivers are statistically safer and often get significant discounts. Has my credit score improved? A jump of 50 or 100 points can unlock a whole new tier of pricing. Did one of my kids go off to college without a car? That's a distant student discount waiting to be claimed. Did I pay off my car? This changes the entire equation for your coverage needs. You have to reevaluate your own life before you can ask an insurance company to. Don't assume they know or will automatically apply these changes. You are your own best advocate. Step 3 is the coverage review. This is where you stop thinking just about cheaper and start thinking about smarter. Price is what you pay, but value is what you get. Look at your current coverages line by line. Let's start with comprehensive and collision. If your car is now 10 years old and paid off with a market value of maybe $3,000, Does it still make sense to pay $500 a year for coverage that, after your $1,000 deductible, would only pay out $2,000 max? Maybe it's time to drop it and self-insure that risk. Conversely, look at your liability limits. A year ago, maybe 50/100/50 was enough. But if you got a big promotion and your net worth has increased, are those limits still adequate to protect your assets in a major at-fault accident? This is the one area where you might decide to pay more to be properly protected. Also, look for redundancies. Are you paying for rental car reimbursement when one of your premium credit cards already offers that benefit? Are you paying for roadside assistance when you already have a AAA membership? The annual audit is about tailoring your policy to your exact needs today, not what you needed 3 years ago. Now for the main event. Step 4, the shopping blitz. With your updated personal information and desired coverage levels in hand, it's time to go to market. And you do it in a specific strategic order. First, you call your current insurance company. Don't just let the policy renew. Call them and say, "Hi, my policy is renewing next month, and I'm doing my annual review. I'd like to get an updated quote. By the way, my credit score went up 80 points and I'm driving 5,000 fewer miles a year now. Can you tell me what the best possible rate you can offer me is? And can you double check that I'm receiving every single discount I qualify for?" This phone call does 2 things. It gives them a chance to apply new discounts and re-rate you, and it puts them on notice that you are an active shopper, not a passive cash cow. After you have their best offer, you go wide. Use a major online comparison tool, you know the names. Enter your information once and get a baseline of 10 to 15 quotes in minutes. This is your market research. You'll quickly see who the most competitive players are for someone with your profile in your area this year. The market changes constantly. A company that was expensive for you last year might have new, aggressive pricing now. Then you go deep. From that list, pick the top 2 or 3 most promising companies, and then add a new player to the mix, a local independent insurance agent. These agents work with multiple carriers, including many regional ones that don't show up on the big comparison websites. They can often find hidden gems. Call them, tell them the coverages you want, and let them hunt for you. Now you have quotes from your incumbent, from the big national direct writers, and from regional carriers. You have achieved total market awareness. Finally, we arrive at step 5, the final decision. You've done the work. You have a spreadsheet or a notepad with quotes from every corner of the market. You can clearly see who offers the best price for the coverage you need. If your current company is the cheapest, congratulations. Your audit confirmed you're in a good spot. Renew with confidence. But what if they aren't? What if another reputable company is offering the same coverage for $600 less per year? You now have maximum leverage. You can make one final call to your current insurer. Be polite but direct. "I've been a customer for 5 years and I'd really like to stay. However, I have a quote from Progressive for the exact same coverage that's $600 cheaper. Is there anything you can do to match that or at least close the gap?" Sometimes a special retention discount will magically appear. Sometimes it won't, but you have to ask. And then you make the switch. Don't let misplaced loyalty cost you a fortune. Insurance is a business transaction, not a friendship. If you can get the same product from a reputable company for significantly less money, you take it. The switching process is painless. You can set the new policy to begin the exact day the old one expires, so there's no lapse in coverage. This 5-step annual insurance audit is the master key. It's the system that guarantees you're not falling victim to price optimization or the loyalty tax. It ensures your coverage evolves as your life evolves. And it harnesses the power of market competition for your benefit, year after year after year. Saving $500 is great. But saving $500 every year for the next 20 years of your driving life? That's $10,000. That's a down payment on a car. That's a family vacation. That's a serious contribution to your retirement fund. It's not just about finding cheap insurance. It's about making a smart financial decision that pays dividends for decades. The single biggest mistake people make is doing nothing. They let that renewal notice come in the mail, they see the price went up 8%, they grumble about it, and then they pay it anyway. Because it's easy. But now you know the system. You have the 10 smartest ways to break that cycle of overpaying. So here's my challenge to you. Don't just watch this and think, "That's a good idea." Put it into action. Right now. Grab your phone. Open your calendar. Find your renewal date, go back 45 days, and create that recurring annual event. Shop for car insurance. That one simple action is the first step to taking back control and ensuring you never ever overpay again. If this video gave you a concrete plan to save money, do me a favor and hit that like button. It tells the algorithm that this is valuable information, and it will help other people find it and save money too. And be sure to subscribe and turn on notifications for more no-nonsense guides to mastering your money. Thank you for watching and drive safe.